So that's the difference between a stop order and a limit order. So if we do the reverse for a buy scenario, like when price is going up. So if you're predicting that price will go up, instead of placing, remember I said the stop order will be above price. Let's say around this area. So assuming price is here, where this candle currently is, now for a stop order, you'll be putting the order here, okay? You're saying that price will come up, take you into the trade, and continue going up. Okay, good. Now for a limit order, you will place it below price.
Below price.
Yes. So you're now saying that even though price is here, I think it will come down, which is what it did here. It came down to this area, then exactly get you into the trade, activate your trade, and then go into profit as you rightly predicted. Okay, so that's the difference between a stop order and a limit order, and then a market order. A market order is quite simply saying, I don't care if it goes down or goes up. I just think it will go up, so I place my order exactly where price is, and I expect it to go directly into the predicted direction. Okay, so that's the difference between all that. So what's a lot size? When we say a lot size, we don't gamble in trading. We plan.
I have a question.
Please, yeah, go ahead, Victor.
Okay. What type of market order? Sorry, what type of order do you advise? Like, if would want to.
Okay.
Is it the limit?
No.
Market order, because the one I actually was trading the demo account I'm working on is I think from an explanation is market order.
Yes.
So I didn't know about this, but I just watched 15 minutes and 4 hours after that. I just studied the chart, and I actually jumped somewhere. So,
all right. Now, no, it's okay. It's okay. You're practicing, which is key. You need to familiarize yourself with the chart. Just do anything on the chart. That's the stage that you're on. We're not talking about you making profit or making loss. That's not where you're supposed to be now. What you should be talking about is just familiarizing yourself with the chart. Okay, now, there's no hard and fast rule to whether you should take a limit order. That's to answer your question now, or a stop order. No, that is dependent on where the market currently is and what your expectations are. Okay, now assuming, look at where price currently is, this area. Let me draw a box around it. This is where price currently is now. Okay, now price is here. All right, now based on my analysis, for instance, okay, if I think, suppose now this price, there's a gap here. I think the market has opened, and there's a gap that's been created here. Okay, now it's about going up to cover that gap. Now, if I think based on my analysis, so when you get to that point, it is your analysis that will determine the type of order that you will place, the analysis you've done on the current market situation. Now, look at price. Price is going up from this area. There's a bit of what is called a consolidation. What does that mean? Where price is moving without any particular direction.
Without any direction.
Exactly. It's just choppy. Okay. Now, after the consolidation, price just pushed upwards here. It just pushed upwards, straight upwards. Okay. Now, there's no way you can tell that this is going to happen. What happened here? Okay, so now you may be thinking that based on my analysis, okay, there is a support level, there's a low level here. Okay, I'm thinking that before price will go
there will
up,
be a lower high, there will be a higher high.
No, maybe it will come down to this area before it will go up. It will come down to retest this area before going up. So what do? I place a buy limit here around this area. So what I'm saying is that I expect that price will come down, trigger my trade,
then buy.
Right, then before it starts going up. So if I place a buy limit here, it will now come down, trigger my trade and go up. So that's why I'm saying that it depends the type of order you place is dependent on the analysis that you have previously done. But if I think that, okay, I don't think it will come down, I just think it will go up. So I place a stop order above where prices, assuming prices are this line. So I just think that it will go up. So it just continues, it does all that, and then goes up and triggers my entry. Okay.
Yes, sir.
So that's the difference. Taking an order is largely dependent on your analysis of current
analysis and plans.
Market situation. Yes. All right. So let's continue. What is lot size? Now, if you go to this area where we have orders, if I say new order, for instance, you will see volume. Okay. So the volume.
Sorry, sir, I can't see that, sir.
No, don't worry. Later you get that. It's not part of. Okay. Let me get. Can you see it now?
Yes.
Okay. So this area where it says new order, that's where we place an order. That's where we say, okay, I'm trying to buy, sell by market, buy by market. Okay. So if I drop this place here, you see market execution. What does it mean? I'm buying at the current market situation. Okay. Then pending order. Under pending order, that's where you now get to see the buy limit, sell limit, buy stop, sell stop, buy stop limit, sell stop limit. Okay. All right. So those are the categories of the order. Now, this is where you now see what is called volume. The volume is where you impute your lot size. What does that mean? Your risk of exposure. So if you say to yourself, for this trade, I'm so confident that it's going to go in my favor, so I am risking 10% of my account on the trade. That's your call. What if it goes against you? It means you'll be losing 10% of your account in one go. If you have a $1,000 account, for instance, 10% of that is how much?
That's
$100.
$100.
Exactly, in one trade. So if you take 10 trades, risking 10% each, you are losing, your entire account is wiped out. Okay? So your lot size is, number one, dependent on your account size. Number two, you don't over leverage. What does that mean? You don't risk too much on a single trade. Why? Because the trade can go anywhere. We don't put all our eggs in one basket. What makes a good trader is not the fact that you won or lost a single trade. It is the collective win or loss rate that makes a good trader. So at the end of a week or at the end of the month, you say, okay, collectively, I won 7 trades out of 10 trades I took. So each of those trades that you took, you risk 2% or 3% or 5% each. You can go to sleep quietly and you don't have a heart attack. Why? Because you know that, okay, if I lose this trade, I'm losing just 2% of my account, it's fine. Maybe a $1,000 account, you lose $20, it's fine. You know that if I win the next trade, I will recover the money I lost on the previous one. So that's the planning that goes into trading. And that's how you take your lot size so that you don't risk too much on a single account, on a single trade.
Sorry.
Yes.
I also have a question here.
Yes, please.
Who
am I on to? Is this Victor or?
Yes, this is Victor, sir.
Okay, shoot.
We have 2 Victors here, actually, Matt.
Oh, so your name is Victor too?
Yes, Victor. That is right.
Oh, sorry.
He's also Victor.
Okay.
All right. Go ahead, sir.
Yes, sir.
Thank you.
So my question is, now, take for instance, I enter the market at a particular maybe size, like calculating
Lot
some of the
size.
previous yes. Then I've actually calculated my risk and every other thing to know what I would actually
risk on a single
want
trade,
to risk for. Then I now came in and buy at a particular point.
Yeah.
So if I buy, how do I know? Like I can actually see where the market is going to.
Yeah.
By the virtue of the graph.
Yes.
So, but then that is a movement. How do I know when I lost? Is it
Okay,
when?
all right, so it's simple. Now what happens is that you see this gray line here?
Yes.
This gray line. Okay, that
Yes.
gray line is your bid and your ask price. Okay, that's what this line tells you. It tells you where market currently is. So if you place a buy here, you'll find a dotted line like this will appear. Let me do this. So once you take a position, you'll find that a dotted line will appear like this. Now this dotted line will not move. It will just to the left of your screen, you will see the position you've taken, whether buy or sell. This is my live account, so I cannot just randomly place an account. Usually I don't teach with this. I cannot randomly place a trade. If not, if I was on a demo, I would have, actually I was analyzing the markets in readiness for the week before this class. So if I place a trade, you will see that it will appear to my left. It will show you buy or sell, and it will place the amount, the time, where the scale, if it's 79, 78, to place it beside the position you took, whether buy or sell, to your left. Okay. Now the line will not move, but you will see that the market line will be moving. Okay. So if you said buy, you expect that this line should be going upwards. Okay. If you say sell, you expect that the line should be going downwards. So now, if you say buy and this line starts going downwards, it means you're wrong. You will start seeing your account balance reducing.
Yes.
Okay. Now, if you say sell and this gray line starts going upwards, okay, you will start seeing your account balance reducing. But if you say buy and this gray line continues going upwards, your account balance will be getting in positive. You will see the increase. Okay. If you say sell and it starts going downwards, it means you're right. Your account balance will start showing positives. Okay, which is what we all expect to see.
Yes.
At the end of the day. So now, when you place a buy, we also place what is called a stop loss. Okay, what does that mean? It means if I place a buy here and I'm wrong, and this line starts going down, whatever happens, I don't want it to go beyond this place. It should take me out at this current line here. Okay, so it means if it's going in the negative and my account starts reducing, whatever happens, I want to cut my losses at this point. It means I am wrong. So when it gets to this point, the trade will close and you have lost whatever amount between here and here. And that's where we say the lot size is about. Now, if you look at this, you'll see the first digit or the first series of numbers is 78.500. Can you see that?
Yes.
Now, the second number says 6 bars. Can you see that? Good. Now, what it means is that between where you entered the market here.
Hello.
Can you hear me?
Yes.
Okay.
Yes, sir.
Okay, great. So I'm saying that if you place your stop loss, what does that stop loss mean? Stop loss means the point where if the market gets to that level, take me out of the market. I don't want to lose anymore. So we always trade with a stop loss because you may go to sleep and the market spikes against you and you just wipes out your account. Okay, so you want to say, I place a stop loss at a certain point in the market, and that's the point that I don't want to lose anymore. Okay, if I am wrong, if I place a buy at this point, for instance, can you see my cursor?
Yes, yes.
So if I place a buy at this point, I expect market to be going upwards. Now, but if I was wrong and the market starts going downwards, what I'm saying is that I don't want it to go down below or below this point. Okay. So that's your stop loss. That you're saying stop my losses at this point. Okay. Now, yes, and then again, the reverse is the case. If you place and you say to yourself, the profit cannot go on forever. So if you place another line above where you entered, that's called your take profit line. So you're saying if market gets to this point, it means I'm right. Give me this profit and I'm okay with this profit. Close the trade. Okay, so let me represent this one with a green, the take profit line with a green. Okay, and I represent the stop loss line with a red. So you see what it means. So this is where I say, if I'm wrong, take me out of this market. I don't want to lose anymore. Okay, so it's there.
Okay.
If I'm right, then if you get to this point, take me out of the market. I've had enough profit. I don't want to get a bit of profit and then you now come against me and make me lose. No, take me out of the market. So that's what it means. But if I'm selling, I'm saying this take profit will now be underneath price, below price. My stop loss will now be above price. So you're saying, if I say I want to sell, I'm expecting the market to come down. So if I'm right and it's coming down, if it gets to this green line, take me out at this point with a profit. But if I sell and it starts going against me, take me out at this red line with a loss. I don't want to lose beyond this point. So that's the difference between a take profit and a stop loss. Usually for a buy or a bullish market, the take profit is above price and the stop loss is below price. And then for a sell, the take profit is above price and the stop loss is below price. Okay, so that's the difference between your take profit and your stop loss.
But sir, since these lines will be going up and down and up and like the high low, the low high.
No, that's
does it mean?
No, what I said to you earlier is that the lines don't move. Your stop loss line does not move unless you move it. Your take profit line does not move unless you move it. Your entry point does not move unless you move it. The only line that moves is this bid and ask line. That's the line that represents the movement of price. That's the one that keeps either going up or going down. You see, let me move this one, this particular line, right? Now, I'm going to show you how it moves. Let me go to a faster time frame. Let's say I go to the 1 minute. You see it moving. Okay, so this is the 1 minute. Let's see if it moves. I don't know if the market is open or the market opens at 11, maybe 11 p.m. our time. So right now, I guess the market is open. It's supposed to move. Okay, so this line actually is supposed to be moving, okay? So you will see that the price line, that's what is called a price line. It's supposed to be moving, okay? It's supposed to be moving. And that helps you to, you know that, okay, the market is currently in motion, right? So today is Saturday. Today is Sunday night.
Sunday night.
Yeah, so it's supposed to be open by now at this time, okay? All right, so that's the thing. But your order line, where you place the order, that doesn't move. That is static. If you've placed the buy, you've placed the buy until you close it. If you place the sell, you place the sell until you close it. Price will only move away from your order line, either into the positive where you predicted or into the negative against where you predicted. Does that answer your question?
Yes, sir.
All right, great. So let's move on. We've talked about your lot size, which is your risk, your level of exposure to risk. So we said you don't want to risk too much on a single trade because the trade can go anywhere. The market doesn't respect you or respect me or anything. No, the market moves. All it does is that if your technical or fundamental analysis is correct, then it will go in your favor. If your technical or fundamental analysis is wrong, then it goes against you. Does that make sense, guys?
Yeah.
Yes.
Okay, great.
I have a question, Mark.
Please shoot.
I have a question, Mark. Okay,
shoot.
now, how do I select my trade? You know, we have the euro, we have the USD against.
Yeah. If you see to the bottom, you see all these white things here. Those are all the different different pairs. Okay. So I can pick any one. I can say AUD card, for instance. It should open. Yeah. All right. So that's waiting for updates. That you see that. That's open. Forget about all these lines. These are my previous technical analysis that I did, and I'm waiting for price to go to the area that I wanted to get to before taking my trade. Okay, so if I want to do an analysis on this, I analyze this market and then I make a decision on this market. Okay, if I'm done with this and I probably don't see something I love that will, or I don't see something that I think will go in my favor, I move away from this and I go to the next one. Okay, now this is a different one. This is AUD CHF, the Australian dollar against the Switzerland CHF. Okay, so if I look at this, I don't find something that I see and I think that will go in my favor, I just move to the next one. Okay, so that's how it works basically.
So do you advise I use a phone or a laptop for this?
Oh, I can tell you confidently that you need a laptop. I can tell you confidently.
Okay.
Now, a phone can do it, but because you are just starting, you need to be able to chart look at the market, the charts patterns and all that, and it will help you to, if you can afford a laptop, I think you should get one. Okay. Now, a phone is limiting. A phone can work. Okay, but it's quite limiting. If you want to do this and make some good money from this, I think you should invest in the tools. And one of the tools you need is a relatively strong laptop. Okay, so but yeah, if you have a phone, yes, you can still chart, look at your charts, analyze the markets on the phone, but you do better. There are features and all that are on the laptop that is easier to understand on the laptop than on the phone. Okay, the phone is a bit, bit limiting.
Because why I asked is because I'm on MT4 right now.
Yes.
I can't see all these options on the MT4 on my phone.
Yes, no, so they are there. They are there, but you have to look closely. So maybe
it's even better to use your MT5.
Yeah, no, it's all the same. Don't worry about that. Later we'll talk about that. Let's not get ahead of ourselves. But with the phone, maybe much later we'll show you how to navigate with your phone. But I think I will always say this. I will always say that the laptop or the desktop computer is always better. The desktop version is usually better. All right, so because of our time limitations, let me see. I think they've added some time for us, so they give us a gift. All right, so let's continue quickly. Okay, so the last thing we'll look at today before the next class is the candlesticks. Okay, so like I said, this is a beginner class. So if you see all these things, right? See the way they are, the red and the green. Okay, now you may have heard watching CNN and all that, bullish market, bearish market, bullish market, bearish market. When these candles move, they don't move in a straight line, they move in a zigzag pattern, okay? So your job as a trader is to identify what the market is doing and rightly predict the direction. So what we do is to use previous data, all these things are data, okay? These lines, okay? We use them to try to predict the future and where the market is headed. That's what technical analysis is about, okay? So now these things come in different forms. There are forms that are called Renko chart patterns. They come also in what is known as the line charts, if you like, okay? The line chart. They also come in what is known as the bar chart, okay? So what is before you now is the bar chart. It's all the same thing. Some people use these bars the way it is appearing on my screen now. Some others use the line chart. It's just the same thing. But we prefer, and the most popular way rather, is the candlestick pattern. So that's what we're going to focus on, the last thing we'll talk about, okay? So now you see the green ones and the red ones, right? Are you with me, guys?
Yes, sir.
Okay. Yes, yeah, read before. Yeah.
Good. So you see the green ones and the red ones. Now the colors don't matter because people can swap the colors into any form they like. What's important is the direction of the candles, right? So if the candles are going upwards or the candle closes, I'll tell you what I mean. It's going upwards, it means it's a bullish market. If it's coming down, it means the market is bearish. Okay. So, but one candle, actually, let's use one single candle to explain. Okay. So now, the way you can tell that a candle is a bearish candle is where it opens and where it closes. The same way you can tell that a candle is bullish, it's not the color, but where the open is and where the close is. Okay? So let me represent it with this. Just something like that. So I turned that to red. That's that. Oh, sorry. Let me fill it up to. I feel that. All right. So great. So that's a red candle. Okay. Then we have this. This is known as the wick. You may not always see this. Come on, I don't know why it's jumping. Okay, so let me make this bigger. I think the dimension is not. All right, so that works. So let's take away all this. So what you see is just like you have your candle, regular candles at home. What you see here, these lines are known as the wicks. What differentiates one candle from the other is not necessarily the color, because the color is, people can choose any color to represent it depending on what's friendly to your eyes. Okay, does that make sense? So let's change that to green, for instance. Okay, change that to green. Only drab, whatever. Doesn't matter. The color doesn't matter. What matters is where the candle opened and where the candle closed. Okay. Closes. Now, for a bearish, if you want to say a candle is bearish, because now I can change this to pink, white, red, purple, any color. Okay. So the candle for a bearish candle, right? It opens at the top. It opens at the top, right? It closes at the bottom. And then it gives you what is known as a high. Opens here, gives you a high, it starts dropping, then gives you what is known as a low point. Okay, I'm going to just label all these now. It gives you what is known as a low point, and then it gives you what is known as the close. Okay, so here, and here, that's what tells you that a candle is bullish or bearish. Okay, so put a text and call this open. That's open. If you can see me. So this is open. Okay. This is high. This is high. The topmost part here, that's the tip of the wick is high. Okay. Then this is the low. Bottom of this is the low. All right. And this is the close. This is the close. So here you have the close. Okay. So what this means is that at the start of the day or the hour or the week or the minute, this candle opened here, as in orders came in at this point. Oh, sorry. I mean, the candle opened here. Orders came in here, correct? And then it's more demand came into the market and pushed the market to this level, giving you a high. And then supply came into the market and pushed it down, forming what is known as the body. Now, this is known as the body of the candle. And then it pushed it down to this point. And then the bulls came into the market and said, no, it can't go below this point, and pushed it to this point and then ran out of time. So the day, at the end of the day, it closed there, or at the end of the hour, or at the end of the minute, it closed at this point. Okay, so here between the open and the close is the body. I hope that makes sense.
Yes, sir.
So between the open and the close is the body. Now the reverse is the case for the bullish candle. In this case, usually it opens where the bearish candle closes. Well, that's the textbook version, because sometimes you may see what's known as a gap or some other slight differences, but the textbook explanation is that it's the next candle usually opens where the previous candle closes. Okay, so here you have the open, and that's what tells you that, okay, this is a bullish candle. It opens at that point, and then you have a low. You have a low, right? And then you have, then it start pushing up, and then you have a high. You have a high, okay? And then you have a close. You have a close. Sorry about that. Have a close. So that's the high point, and this is the close. So in between the open and the close is your body. So now if you look at everything we have here, it just rightly depicts what I've just explained, you know, to you, okay? So we use the candlesticks to do our analysis. We don't use the graph, we don't use the bars, we use the candlesticks, okay? So,
sir, please.
Yes.
Sir, please, can you make analysis with some of these the candlesticks, like the one already arranged, so that we can get it more clearer, please, sir?
I don't get your question. What kind of analysis?
Like, if you can actually help us to increase this chart so that we can see.
Oh, you're not seeing clearly.
Yes, actually,
like this,
sir.
like this.
Yes, like this. Yes, so that we can actually, you know, yes.
Oh, okay. So
we can use this as explanation.
Okay. Well, okay, fine. Now, what I've done here, what you see here, that's exactly what you see here. Okay, so let me zoom it in, if that's what you want. So this is the highest form it can get, all right? So now you see the candles in different forms, different shapes, different sizes, okay? Now you see this one has a big body, but still is the same thing. This one opens here, making it a bearish candle, gave us a high, okay, at the tip here. So if I put a line there, it gave us a high, okay, and then it pushed downwards, gave us a low at that point, and then closed here, making it a bearish candle. Okay, the one before closed as a bullish candle. Why? Because if you look at the one before, it's closed here, right? And then this one opened here. There's no wick to the downside. Immediately it opened, it pushed upwards, gave us a high, right? You see my cursor, and then sorry about that, give us a high, and then push downwards and closed here. You see that? So, and that's what happened with the next one. Immediately it closed here. The next one opened at the exact same spot at that point, then pushed upwards, gave us a high, then pushed downwards, gave us a low point, okay? And from the low, it pushed upwards and closed at that point, okay? Then the next one opened at exactly the same spot here, and then it pushed upwards, gave us a high, then pushed downwards, gave us a low, then pushed upwards and closed at this point, okay? In a different class, we'll talk about the different candlestick patterns and what they may likely represent, because we also use this, the shape of the candle to try to predict the direction of the market. Okay, now a candle like this that you see, that's just a cross, it means it opened and closed at exactly the same spot. It opened here, gave us a high, pushed downwards, okay, came back and closed at exactly where it opened. Or it opened here, gave us a low, pushed upwards. You can't really tell, except probably you were looking at the candle when it was in motion. Because when it closes like this, you can't tell. This is a typical example of a candle that is indecision. It doesn't give you any particular direction, okay? So, but it's also, we use this to determine to make some analysis in the market and try to predict the direction of the market, okay? So that's that's about candle sticks. The next thing we'll talk about on a later day, we will be looking at what support and resistance is about, the movement of these candles. So when the pressure is coming from the bottom, what is that called? That's called in regular parlance, it is known as support. Okay, but we call it the supply zone. Sorry, we call it the demand zone. And then when the pressure is coming from the top, like you have here,
the supply zone.
Yes, that's called the supply zone. Okay, so in between you have some mini supply zones, demand zones, supply zones, demand zones. Okay, in again in regular parlance, it is known as support. Okay, it's known as support. Okay, and resistance. It's known as resistance and support. Okay, like you say, ceiling and floor, okay, this area, resistance, all right? So in the next class, we'll be able to determine what makes an area of all these movements, what makes one area support, and what makes the other resistance. So your homework and assignment is to go and look up what support and resistance is about, so that when we come to discuss it, it will make the work slightly easier. So once again, just visit babypips.com. You'll find the information you need there. Again, you can also, so number one, we're reading up on support and resistance. Number two, we're reading up on candlesticks and candlestick patterns. There's a difference.
Okay, sir.
Right?
Okay, sir.
There's a difference. You have candlesticks, which basically explains what I just did. And then you have the patterns, that some are just long, full body candles. Some don't have the wicks. Some just closes in a very funny way, like, you have the cross. And then some closes like a hammer. Let me look for a hammer. Something that looks like a hammer. And then some closes like a grave stone. The stone that you have on the grave. It closes like that. Okay. Basically, you'll find all those different patterns. You see this one here? Let me zoom in. See this one here? That looks like an inverted hammer, this one. Can we see this one? So they represent something, okay? Then you see this one also that looks like a regular hammer. Then you see this one is inverted. Then you see this one again, okay? Then you see this one again. So they represent, we use them for technical analysis. So just get on Baby Pips and, read a little bit on that. So that, like I said when we started, we don't want to concentrate too much on theories. We want to get all these theoretical parts out of the way so that we can move to strategy and how we can make money. So any other questions so we can tie it up, guys?
No, thank you, sir.
Victor, number 2, any other questions?
Yeah, thank you very much. No questions for now.
For now, okay, so please, let's do the research, do the reading. The next class, maybe on Wednesday, we'll dive more into details, look at what support resistance is about, okay? And if there's any other thing, we'll probably have to look at the desktop interface of the MT4, MT5 and navigate through it, and then we'll take it from there. All right, thank you, guys.
Thank you, sir.
Have a nice week ahead.
Good night. Thank you so much.